Nobody likes to see their investments going down. There's nothing worse than having immediate access to all your investments on your phone, logging in every day and being presented with a sea of red numbers. Unfortunately, that's the way it's been since the turn of the year for most people. Last month, the S&P officially dropped into a bear market, losing over 20% of its value.
The NASDAQ has been in a bear market for many weeks. The Russell 2000 has been in a bear market for quite some time. So it's almost like the S&P 500 is catching up with some of the bearishness, the price action that we've seen in other markets.
It might well get worse too as inflation climbs ever higher. The global situation isn't great to say the least, and there are a lot of people looking around wondering what might happen next. These are uncertain times, so what to do about volatility, and should we even be paying any attention to it at all? Huge stocks like Amazon, Google and Tesla have all been beaten up hard recently, but that's nothing compared to the likes of PayPal, Netflix or Etsy. These are all popular companies that I see people talking about buying all the time, but the big problems then arise for anyone who has committed their resources to any particular individual stock. Getting back to even on your investment or recovering your losses when they take hits like this starts to look a long way off.
I'm all in.
Investing in the stock market can be a galling experience for the impatient, more so in these uncertain times. In a bull market, that's the name given to a time when valuations are collectively increasing. Everyone can look like a genius. It seems that for a while you could have thrown a dart at a list of 1,000 different stocks and come up with a winner whatever you hit. Social media was awash with folks giving out their tip for their next hottest growth stock. The conversation seemed to shift from rational investing in strong companies and index funds to getting company A, B, C to 10x your money in a year. There is no investing here, that's gambling, that's plain and simple. And for a while it seemed like everybody was winning. But now we aren't winning. Sentiment is grim, the sell-off is continuing, and as I mentioned earlier, there are a lot of decent looking companies that have had something of a haircut on their valuations. But rather than panic, it's probably time to look at how you can continue to invest in a bear market. It's time to look at how we need to show a little faith. Check this graph out. What you're looking at here is a timeline of major global events since about 1870 and what just $1 invested in a large cap index fund would look like today. It shows us historically at least that it's probably just best to be patient, buy and hold quality assets and stretch your timeline for as long as you possibly can. Events as horrendous even as World War II have been recovered from. Pandemics, even the financial crash of 2008, markets have always recovered and marched on to new highs. So let's caveat that with the fact that historical performance doesn't necessarily guarantee the same returns in the future, and that I'm not financially qualified in any way to be giving any kind of advice. But I can read and I can see that this graph is moving upwards over a long period of time. More on how I can use this graph to my advantage in just a little bit. But first, what are you going to do about this bear market and how are you going to keep dropping your money in? Well, depending on who you listen to, you're going to hear very different things. Buy the dip is the battle cry from Twitter, like anyone knows what they're really talking about. Buy the dip as if there is this unlimited amount of cash just sloshing about that you can throw at your investments anytime they creep lower. Buying the dip is this idea that something is now valued at a lower price and therefore represents some kind of bargain or being on sale. But isn't buying the dip just a fancy way of trying to time the market? I mean, you can't possibly know if you're buying at the right time, the bottom or anywhere near it. And every time you break from your regularity and react to something going on, you're basically saying, now is the time to invest. Specifically, going out and buying a dip is fortune telling. Dollar cost averaging is the next strategy, the idea that you buy into your favourite stocks and shares on a regular basis. You buy your favourite assets and you hold them, whatever the price is on that given day that you would normally invest. This means that over time you get an average price on your assets with the expectation that this gradual buying is going to make the highs and lows a little bit less high and a little bit less low. A smoother road to success, if you like. Now I can get behind this idea, but I still think it's very difficult to pick the right individual stocks each time to average into. At the best of times, it's hard to pick stocks successfully. It's not as easy as it sounds. Something like 80 to 90% of active fund managers can't beat the market over the long term. That figure fluctuates a little bit depending on what data you're looking at, but when I say they can't beat the market, I mean they can't beat the returns made when investing collectively in the S&P 500, for example, which is the largest 500 publicly traded companies in America. These guys are meant to be the best and brightest in this space. They have all the data they could wish for, all the charts they could ever need. They've had all the training and they are entrenched in this environment all day, every day. So what makes retail investors, people like you and I, think that we could do better when we have other things like jobs, kids to look after, and 101 other things to think about? You see, any individual company can be affected by timing, market sentiment, industry news, environmental, economic factors, supply chains, inflation, war, rumours, government policy, and so on. If any of that doesn't make sense to you, then it's just another reason to stay away from trying to pick stocks. Any single piece of news can send the price of a given stock rocketing up or down. It's why I'm not interested in investing big chunks of my money into individual companies. Which brings me to my next way to invest in a bear market: ETFs, exchange traded funds. ETFs offer instant diversification wrapped up as one easy holding. Personally, I don't have the time nor the inclination to try to keep up with all the news and speculation around individual companies. And when you're not prepared to do that, or you don't have the chops to dissect and analyse all the information to give yourself the best chance, then anything else is just going to be a big giant L in the long term.
You get nothing. You lose. Good day, sir.
Buying a basket of stocks in a single ETF takes most of the mental load away from me and still lets me invest sensibly. So we take that idea and go back to the graphic that I showed you earlier, and this is why I like index investing so much. In this example, I could have continued to invest in a large cap tracker pretty much without any sort of thought, and I would have been just fine. Sure, I might have missed out on buying Amazon in the 90s, but then these sorts of meteoric rises are few and far between. Nobody really talks much about Kodak. Average earnings are okay for me, and it's not just me. Warren Buffett reckons so too.
The best single thing you could have done was just buy an index fund and never look at a headline, never think about stocks anymore. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and it would come to $51 million now. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out.
The sentiment for me here is that while the markets are collectively down at the moment, those markets are collectively going to recover in the future. At least that's my hypothesis. So investing in ETFs is a very simple way for me just to ride that wave. It's why I moved my ISA to InvestEngine for this particular tax year. You can invest in all manner of ETFs and index trackers on InvestEngine, including all the Vanguard ETFs that underpin and make up the vast bulk of my investing. I'll give you a look at my InvestEngine portfolio in just a minute, but InvestEngine lets me invest up to £20,000 tax-free allowance per year, where any profits or capital gains or dividends or anything like that are entirely free from tax. FCA regulation and FSCS participation give me the peace of mind that my investments are protected up to £85,000 should anything go really sideways. And that's the same for all my ISA accounts. Of course, investment values can go up and down as we've seen, so it's really important to understand that there's no perfect way to invest. So like I say, when you invest in an ETF, you are buying a little piece of lots of companies all grouped together in some way, perhaps by geography or industry, company size, something like that. But I would go so far as to say that for long-term investing, ETFs are better 100% of the time versus picking stocks on an individual level, so long as you can find a low-cost tracker. Another plus side of owning an index tracking ETF such as VUSA, for example, means that you will avoid a total loss of your capital, whereas if you pick a couple of stocks and invest everything in those, you could be virtually wiped out overnight. In saying that, ETFs will never beat the market. They're not designed to. They're designed to track something, and from that point of view, they will always be fractionally below the market that they're tracking. InvestEngine's entirely free platform is as low cost as it gets, and it allows me to keep as much of my money for investing as possible by not charging me anything for the privilege. But even if I wasn't comfortable about picking my own ETFs, InvestEngine offer a managed option at 0.25%, which itself is still very competitive. So look, ETFs aren't completely brainless. It's not to say they don't involve any research at all. You can't choose which companies are part of an index fund, but you can choose what kind of ETF you want. Socially responsible investors, for example, could opt for an ESG ETF. It's kind of like ethical investing in some ways. But investing doesn't have to be hard. It doesn't have to take up a lot of your time or occupy a lot of brain space. As is often the case, the simple strategies are often the best. And with that said, let's take a look at my InvestEngine portfolio. Here we are in InvestEngine. This is my ISA. It's a DIY ISA, which means it is entirely free. InvestEngine do not charge me a penny to host this ISA. Of course, the 4 ETFs that I have in here do carry charges, annual charges, but that's the same as you would find anywhere. But entirely free to invest this way with InvestEngine. So the couple of things I just want to draw your attention to, and that is that this particular portfolio is made up of 4 main holdings. They are the Vanguard S&P 500, the FTSE Developed World, the FTSE 100, and the FTSE All World High Dividend Yield. So when I set up this portfolio, I decided that I wanted 30% in the S&P 500, I wanted 30% in the Developed World, I wanted 20% of the FTSE 100 here in the UK, and 20% for an All World High Dividend Yield tracker. So the cool thing about this is that I can click any one of these ETFs and I can actually go down and have a look and see what it is I'm investing in. So there's 1,575 stocks in this one ETF, and that's really cool because it gives me an awful lot of diversity without really having to think about it too much. So you can see that we've got companies like Johnson & Johnson, Taiwan Semiconductor Company, Home Depot, Procter & Gamble. These are all big companies paying dividends. I can see whereabouts in the world they are, and I can see the kind of sectors that they're involved in. And I can get a similar kind of breakdown for the S&P 500. Apple, Microsoft, Google, Amazon, Tesla, these are all the big holdings in this ETF. So that's a good example as to how I'm getting diversification. Even in these tricky times, my money is well spread out across a good number of companies, and hopefully when the market starts to recover eventually, then I'm going to be able to ride that wave back up. So that's one way that makes my investing easy in a bear market. The other thing that's pretty cool that InvestEngine takes away all the mental load is this investing options that they have over here. So what I can do is auto invest available cash. So what that means is that anytime there is loose money lying about this account, anytime that dividends are paid or anything like that, it's going to automatically assign that money according to the weightings that I have here. So 30% will go to S&P 500, 30% the developed world, and so on. It means that I don't have to constantly monitor my portfolio, make sure all my money is getting invested at the earliest opportunity. The other cool thing is that we can set a monthly top up here. So you can set up your investing to happen on a particular day. So say payday, for sake of argument, you want to invest £100, £200, £500, whatever amount of money you like, then InvestEngine can be set up and it'll do that automatically for you, so you don't even have to think about it. This is great for investing because it takes away that emotional aspect. We all make mistakes. We all act on impulse. We can look and see our holdings are going down or they're going up, and we might make a quick judgment based on that. But you can set up your monthly top up and your auto investing to just completely take the emotional side out of investing, as some of the really cool tools that you can use to invest in times of uncertainty like this. Of course, just following along blindly is no good. If you want to see just why InvestEngine is so good, then you need to see this video here.